I'm Alex Foster and I'm a tax partner here at Blick Rothenberg, and I work in our private client team, and I'm delighted to be joined by my colleague Rob Burgess, who is sitting in our US-UK team doing very similar work to myself. So we're going to be talking today about tax implications on divorce and civil partnerships. So first of all, Rob, what are the main US tax consequences on divorce?
Thanks, Alex. So there's a couple of points to note. When we have a US person who is divorcing or separating from a non-US person, there is going to be a taxable transfer for US tax purposes. This, of course, could create a US tax liability at the point of transfer. The other side of the coin, where there are two US individuals being divorced or separated, is that those transfers would be non-taxable from a US perspective. That doesn't mean we don't need to consider it though, because each asset that's being transferred may have an inbuilt tax liability associated with it, and we need to fully understand the net of tax value of those assets being transferred. Many of our clients are UK tax resident, and therefore we also need to understand the UK tax rules. Would you be able to talk us through those?
Sure, so we have very similar rules to the US, but obviously not exactly the same. So for capital gains tax purposes, where assets are transferred between spouses that live together, that's deemed to be at no gain, no loss, so no tax arises at that point. And those rules are extended to any assets that are transferred either under a court order, or if no court order, within 3 years of separation. So for inheritance tax, there's a different set of rules, and the spouse exemption should normally apply, so you don't need to worry about inheritance tax on such transfers.
Great. So in what situation would there be a taxable transfer in the UK?
So on the inheritance tax position, it's the spouse exemption, because if you have a couple with mixed domiciles, then you don't get an unlimited spouse exemption, and it's actually a maximum of £325,000. So you could have inheritance tax consequences. With regards to capital gains tax, it's where you are transferring assets not in line with the court order and outside a 3-year window. So we're looking at a potential mismatch within the rules between the US and the UK, especially where we have a marriage between individuals that have not got the same domicile. And what are we normally seeing in these cases?
Yeah, absolutely. So commonly where there's a US person and a non-US person getting divorced or separating, there is going to be differences between the US and the UK, because that's a taxable transfer in the US. The UK rules may allow for a tax-free transfer. Where we have a fundamental difference between the tax systems, there is the need for advanced planning, and there is a need to consider how both of those systems work in tandem. We can look at things like foreign tax credit planning. We can carefully review the assets to identify if there are particular assets which don't work for US or UK tax purposes, and see if we can do anything to position those in the most efficient manner.
And Rob, what other issues can come up when considering tax on divorce?
Yeah, so looking at things on an asset by asset basis, there can be assets which are tax inefficient in either the US or UK. Thinking of things which are as simple as a rental property, which can be treated differently in the US from the UK, or more complex items such as limited liability corporations or even trust structures have different outcomes and considerations on each side of the Atlantic. So what types of planning would we look to implement from a UK tax perspective?
Well, a couple of extra points to think about on the UK side would be potential for remittance, and where assets have been acquired by one of the spouses when they were on the remittance basis, so funded from untaxed foreign income and gains. That needs to be considered in any ongoing tax implications. Also, where you have different jurisdictions involved, so not just the US and the UK, you need to take into account those particular countries and how they're going to tax the transfers on divorce. And there are also actually separate considerations for where you're considering the marital home and business assets, but that's a subject in itself, and we're discussing that in a separate video.
So what can we do to make transfer of assets incident to divorce more efficient from a US-UK tax perspective?
Well, we have a deep understanding of the tax consequences and the combination of the two jurisdictions of the US and the UK. So really it's having an understanding of the consequences in both countries, and also reviewing any draft documentation and initial ideas of transferring to see what the tax implications are going to be.
There are also some US-centric tools which we can consider. In the US, there's a far more extensive concept of tax assets. This can be things like foreign tax credit carryovers, loss carryovers, capital losses, which can be used perhaps to suppress the tax that arises at the point of transfer. We need to obviously acknowledge that there is a depletion of a tax asset for one of the parties, and we need to consider the UK position, which may not match up with the US.
So to summarise, Rob, what do you think are the most important things to consider for clients and their lawyers before commencing divorce proceedings?
So I think the most important thing is to acknowledge that there's two tax systems to navigate. At the same time, there's also the need to consider that every single asset within the marital pool has a net of tax value. We need to understand what realistically those assets are worth after any tax has been paid, either upon transfer or in the future if they were to be liquidated. So what types of work can we do in this area?
Well, we can produce reports, whether that's a single joint expert report for the court or whether it's a tax report for one of the individuals so they're aware of their own tax position on the potential transfers. And also we can do the calculations of the tax, and also that's backed up with a live spreadsheet which can be manipulated around values and different assets being transferred.